And welcome to this short session where we help financial planners, attorneys, and accountants help their clients be more wealth conscious and tax smart. My name is Edward Cotney, co-founder of Financial CloudWorks. And if you haven't had a chance to look at our software, I beg of you, go look at our software because it is without question the preeminent IRA planning software in the nation. It does great things for IRA planning. It does unbelievable things for inherited IRAs. It does the most comprehensive IRA conversions to a Roth with a QCD. There is nothing like it in the country. And as we've had relationships with our subscribers who use our software, they'll ask some questions occasionally about, well, I don't understand something over here in respect to a tax optimization or a tax efficiency structure. One of the things we want to talk about today is one of the most overlooked concepts that we have in the wealth planning world for people who are philanthropically inclined. It doesn't matter if they're young or old. It's just the process of, is giving cash or stock to charity, which one of these two is better? One of the secrets we're going to share with you is it's just crazy to how this secret is sitting out there. And it's going to be amazing how when you follow the numbers, you go, oh my gosh, I need to help all my clients start doing all of these things better. So what we're going to do is share with you a quick PowerPoint presentation. And if you would like some step-by-step instructions of how to do this as a donor or as a professional advisor, you can reach out to NCW and ask for it's a little 2-sheet instruction sheet that I've prepared, and that will help you go, oh, now I get it. So let's get things going here. Cash or stock, which is best? Well, we all know it's easy to do cash and stock, and so we're just going to talk about the overview of charitable giving just for this. But to help you understand why I'm in this world and why this matters, this is the church I went to as a young child, and it's one of the few times in Alabama where we got some snow at our church in Dayville, Alabama. This is Mount Carmel Baptist Church. And on the bottom floor down there where that white door is where I used to go to Sunday school back in 1965 when I was like 5 years old. And Miss Margaret Keat, God bless her soul, was my Sunday school teacher. And we would go to big church at 10 o'clock, and then they would break us into Sunday school. And then after Sunday school, we'd come back to big church at 11 o'clock. But while we were in Sunday school, we were taught from an early age how to give with the least tax efficiency and wealth optimization ever. In fact, we have taught the entire country that just get your checkbook out or your wallet out and give to charity, and then just make certain you give the receipts to your CPA at the end of the year so they can claim it on your tax return for tax deduction. And unfortunately, that is true, but there's a point in life where we grow our wealth and we start having different types of assets where maybe cash is maybe not the best thing to give. And so what I want to share with you are some of the lessons that we've done to help people do things better. And simply stated, let's take a scenario where let's pretend you have a client who came to you, say, 5 or 10 years ago. They had $40,000 in hand, and they said, hey, Mr. and Ms. Advisor, I have $40,000. Let's invest this into 4 different opportunities, and let's see what happens over the next 5 years. Now, when you think about your client's portfolio, some things do great, some things just kind of stay static line, some things go down. And so, we have losses and we just have, things that are dead on arrival. So what I'm trying to illustrate on this slide is that one of those investments did extremely well. It went from $10,000 to $110,000. We call that a racehorse. I mean, who wants to get rid of that kind of racehorse? I mean, that's a great investment. It's got the uptick like on the hockey stick. Let's go. And another one of the investments did really good too at $90,000. And so we're going to classify that one as a racehorse. But the third investment, it started out of the gate pretty good, but notice about 3 years ago, it kind of flattened out. It just stopped growing. And so I call that one a donkey because it did well, but at least it's not a loss yet. So the donkey here does represent a highly appreciated, poorly performing asset. And this also happens with real estate. We have real estate sometimes where this is an issue and we have to take a concern into whether we want to hold that real estate. If we know that real estate is going to stay flat or go down in value, we need to think this thing is through. And then the fourth investment started out at 10 grand. Here we are 5 years later, it's still 10 grand. You know what? That's just a rock. And of course, we all know what losses are, and we know that there's limits on what we call tax loss harvesting, how much the client can use per year. But the concept I want to teach you today is called charitable tax harvesting, charitable tax harvesting. So it's a spin-off the loss, but we have some far greater tools to work with. So let's pretend to make the math easy, because I am from Alabama, roll tide, two-digit IQ, but let's make the math easy. Let's pretend you're in a state like New York or California or someplace where once you start making about $1 million a year, you're in the 50% tax bracket, state and federal. I'm just rounding it down to 50%, because in California it's about 52.3. But let's just use round numbers. And so at $1 million, if I'm in a state that taxes at 50%, and yes, I know the progressive tax code is here, but just to make the math easy to understand the concept, if I make $1 million in the max tax bracket, that's a $500,000 tax bill. I take home $500,000. And we made the decision to give $50,000 to our favorite charity. So we whip out that checkbook, just like we were taught at Sunday school, and we write this check for $50,000. And that check is deductible, and it is greater than my standard deduction. So therefore, I now get to pay taxes on $950 instead of $1 million. Everybody doing good so far? So we also be going, okay. And yeah, if it's a different tax rate, you just modify the numbers. But again, I'm trying to teach a lot of concepts so that people can get the strategy. So if we are in the 50% tax rate, technically, I am now paying taxes on $950, and now my tax bill, 50% of $950 is $475. My take home is $475. Charity got 50 grand. Taxing authorities got $475. I took home $475. Okay. So we all know that 1040, this is where we put all the information on here as far as clients' names, address, dependents, filing status, how much they made, sources of income, taxes paid, etc. But where we start getting a little bit of trouble is when we get into the Schedule A. Without doubt, Schedule A, line 14 is probably the most powerful tool that your clients can use to mitigate tax. The problem is we just don't think about using Schedule A line 14, which is our charitable donations line, in a manner to help our clients grow wealth and pay less tax. So since we did make a gift larger than our standard deduction, we're going to put that number, $50,000, down here of cash or stock, and it's going to end up on line 14. So for the purpose of the just clean illustration here, we're going to pretend there's no other deductions on Schedule A. And so at the bottom of Schedule A, line 17, is $50,000. And then we'll take $50,000 and put it back over here on our 1040 to show that we have the charitable gifts. And that will help us understand why we have a modified adjusted basis now. And the IRS will go, yeah, the AGI is now 950 instead of $1 million. Okay, so far so good, right? Now let's see how this gets reported. We see the standard deductions. These are a little bit different for 2025 and 2026. They go up a little bit every year. We see when we zero in on line 14 the different types of cash or stock, and we see at the bottom of line 17 the full amount. So I just blew those up just so you're kind of going, where's that at? So let's look at what makes this work. Okay, we got the checkbook out, which is the same as cash. Technically, it's a basis. It's $50,000 with a 50% tax rate. So my $50,000 technically bought me $25,000 of tax savings. Remember just a moment ago, we were paying taxes on $1 million, which was a $500,000 tax bill. We made the gift of $50,000, reduced my AGI to $950. We now pay 50% tax on the $475. And so technically, I made a cash gift of $50,000, which technically reduced my tax bill by $25,000. So to sum it up, I paid $50,000 to charities so that I could save $25,000 in taxes. And most people go, well, yeah, that's the way it goes. And this is how most of America, because they never talk to their financial planner, they've never talked to their CPA or their tax attorney about the charitable giving that they do. And sadly, most of the professional advisors in the country don't know this little secret that I'm about to show you. So remember the donkey we had a while ago? We had the 4 investments. One did great at 110, another one did great at 100, another one come in at 50, the highly appreciated, poorly performing donkey. Remember that one? Remember, we paid $10,000 for that stock, that donkey. That's our basis. And we know that if we sell the donkey stock today, we would have to pay taxes on a $40,000 gain. Well, it is a long-term gain, and yeah, a long-term gain tax bill is less, than ordinary. So we do see some benefits there, but that's not the secret sauce. The secret sauce is what we're giving here. We're giving $50,000 of value in the form of highly appreciated publicly traded stock. My basis was 10 grand. I'm still in the 50% tax bracket. And technically, for the untrained advisor, it still appears that it's a $25,000 tax savings. And on the forms, it is, except for one big difference. The one big difference here is that we made $15,000 of profit off of the donkey versus the cash. And this is where, when I'm doing an in-person live type presentation, the audience looks at me like I have lost my mind. Let's think about this for a minute. If I give cash, $50,000 basis, I get a $50,000 deduction, it saves me $25,000 in taxes. If I give the highly appreciated donkey to the charity, they have to have a brokerage account. Sometimes you have to help the charity set up a brokerage account. It only has a basis of 10. It has a basis of $10,000. It has a basis of $10,000. Charity still got same value. They don't care if it's cash or stock. They're going to convert the stock to cash, and they're still going to spend it because of the charitable mission. But to the donor who's sitting on this block of stock that is not going up in value, and I would perceive that this block of stock is probably going to go down in value since it's been sitting flat for 3 years. The chances of an upward hockey stick here is probably not in the future of this donkey. And my client has made the decision to give $50,000 to their favorite charity. They're going to give their money to charity whether we help them or not. But if we step in and intervene and say, by the way, as your professional advisor, one of the value add components I have here for you is that I see that you're giving $50,000 every year to charity and you're just stroking a check. By giving the highly appreciated donkey to the charity, we're cleaning out the portfolio with poorly performing assets. I mean, think about the lost opportunity cost here with 3 years of that flatline stock. Okay. And by the way, flatline stock also means your AUM is not going up if you're trying to connect a few dots here. So let's tell the client, let's give the donkey stock to charity and then bring your checkbook over here to the office and let's write a check for $50,000 to buy new stock that hopefully will have racehorses in its future. Now let's think about the multiple things we've done here. We've cleaned up the portfolio. We've replenished the portfolio with new cash to buy new assets that hopefully is going to go up in value. We've helped the client actually make $15,000 off the IRS because remember, they got the tax deduction based on the full fair market value of the gift. And the gift was $50,000, but the client only had $10,000 of their money in this. But that $10,000 basis, when you stop and think about this, that $10,000 basis in that $50,000 gift, and that $50,000 gift saves me $15,000. Think about it. My $10,000 investment just bought me a $25,000 tax deduction, which just saved me $15,000. Thank you, IRS, for letting me make money off my gift. This is where the room has normally got their head spinning. They're going, well, wait a minute, I'm missing something here. The issue is cash has a basis of its value. $50,000 of cash is $50,000 of basis. My client is giving hard-earned money to charity first. They have an investment portfolio or a real estate portfolio with some highly appreciated, poorly performed assets that have a low basis in it. And if we give the low basis assets, which are highly appreciated to charity, I still get the same fair market value tax deduction for reporting on Schedule A, whether it's cash or stock. I still get to deduct it on my AGI. Now, there are a few rules about giving cash and stock as far as the maximum amount, the 50% rule, the 60% rule, the 30% rule. But for most of America, that is not an issue. But for the majority of our clients who are giving gifts to charity in excess of our standard deduction each year, this is one of the coolest things that an advisor can bring to the attention of their clients that will help our client save on taxes, make more money, help the advisor increase the AUM. It's amazing how many advisors don't know this, and also help the client be wealthier long term. So that $15,000 profit, this is a no-brainer. I mean, it just plays out well. It's just crazy. And not every case is the same, but when you have high income earners who have highly appreciated, poorly performing assets that are blessing the charities they want to take care of, you got to introduce them to this because it is a totally cool way to do this. And so by doing it this way, it's a timing, combining, sequencing strategy when you step back and think about it for a moment. We're trying to help our client think through the process of each year, which is a chapter in their tax life. How do we best accommodate their timing, combining, and sequencing in a charitable gift to help them optimize the opportunity here? As an advisor, we may want to tell our client, hey, let's set up a donor advised fund. This way, as we're being a proactive advisor and we see stocks that are appreciating, but we know that they're going to go down in value and maybe we don't have an ETF or something to work with, we can just donate that stock over to the donor advised fund, lock in the value today for the tax deduction. We can then convert those shares of stock in the donor advised fund tax-free because it's a 501c3 tax exempt. And then from the donor advised fund, when the client is ready to make those distributions, we can. Most advisors will also tell the client, hey, let's make the gift to the donor advised fund. Let's sell those poorly performing stocks. Let's get new stocks. And maybe we'll trickle the money out of the donor advised fund over time. The point is, the IRS is helping underwrite this. The IRS is helping underwrite this strategy. There is an education curve for this. And several times I've had people say, well, I've talked to my advisor. They've never heard of this. They don't know what you're talking about. And so I wrote a little 2-page summary that talks about this $50,000 gift. And it's got step 1, step 2, step 3. This is what the attorney needs to know, the CPA needs to know, the financial planner needs to know, the donor needs to know, and the charity needs to know. So it's a really short, easy educational thing to do where you can help a donor radically move this needle on their wealth and tax planning scenarios. They're going to give to charity whether you like it or not. The point is, as a professional advisor, we have the unique opportunity to help our donors do better gifting and optimize their tax in a far superior way. Now, we're not going to get into the qualified charitable deduction, the QCD rule yet, but I mentioned earlier that we have probably the most beautiful raw conversion with QCD analysis software system in the country. In fact, I haven't seen any other software platform do this. But we have another scenario where clients who are over the age of 70 and a half, and maybe they don't need their income from their IRA, but they're also maybe talking about doing a Roth conversion. And so we have the software system that can help you show a client, should they do a Roth conversion, if they're doing a Roth conversion, how to integrate the QCD in here to get the optimized scenario for the client. We already have some items up on our website for that. You can reach out to us through our intake on our website, say, hey, I want some more information on this. We can send you the links. You can check things out. But I hope in just this 20-minute talk that we've had today, that when you think about charitable giving and you're trying to help a client optimize their wealth scenario and to do the most good with the most money, this is one of the most overlooked concepts we have in the country. Donating highly appreciated assets such as publicly traded stocks and real estate that may be or may not be highly appreciated anymore because they kind of flatlined in their growth. This is a powerful way to clean up poorly performing assets, get the charitable gift to the donor that the donor wants to have done, and create a more optimized wealth solution for the donors. If you enjoy this type of training, please reach out. We'll be happy to put you on our continuing list. We try to hit one charitable tax planning strategy once a month. If you've got some requests for something you would like to see, please let us know. Again, my name is Ed Cotney, co-founder of Financial CloudWorks, Vice Chairman. I will be more than happy to have any questions that you may have to help you find a great solution. Anyway, thanks for joining us today, and I look forward to talking to you again soon.